right, so thank you guys all for attending. Truly appreciate each and every one of you. This class is definitely, I think, would help advance your careers and how you underwrite deals for individuals that need your services. This is what I do for my clients. I just want to give a synopsis of how I look at deals when I give it to clients, whether they're commercial or residential for investment purposes. We'll start right away, okay? Can everybody hear me fine, first and foremost? I can do everybody can. Okay, perfect. All right, so let me go next here. All right, so our agenda, we're going to talk about analyzing microeconomic factors. It's critical for navigating the dynamics in real estate marketing and making informed investment decisions. Diversifying your portfolio to mitigate risks and maximize your long-term investment gains. We'll also do a case study for exact deal that I did for a client not too long ago. And then we'll have a bonus to the end, and then any questions and concerns that anybody may have, okay? Next slide. So this is my background. Duriel Taylor, born and raised in Miami, Florida. 18 years in this wonderful industry. My aunt had a relatively successful investment firm. So in high school and college, I had to help her in the business involuntarily. So it helped me to understand investing, asset management, property management, all that good stuff. Some of my achievements that I'm very proud of, top 20 under 40, RPAC member, investor, top 5 sales associates, Broward, Florida Realtors State Director, YPN, shout out to YPN. Women's Council of Broward, and I'm also an ambassador of Miami Commercial. And then on the far right, that's my wonderful picture. And if you want to get in contact with me, there's my Zelle information. Just Zelle me at 954-439, and then text me on the side for the last pin if you want to go ahead and contribute to this wonderful cause. I'm joking, of course. My Instagram is there, Duriel Taylor, Instagram, Duriel Taylor, email, dtaylorestate@gmail.com. Have any questions, concerns, I'll be more than honored to help anybody if you have questions, okay? So that's my information. Next slide here. So let's just dive into what is microeconomics, right? I think there are 6 main components of microeconomics, right? So you have interest rates. Interest rates is not just what mortgage interest rates are. Interest rates are also what the feds borrow money out to, right? So whatever that number may be, debtors add a percentage on that, and that's what they borrow money to us as consumers. So high or low is not necessarily a particular number that's advantageous to an investment. Obviously, the lower the interest rate, the lower the debt service, all that good stuff from an investment standpoint. Another key component of microeconomics is inflation. Inflation is very key, does not have any direct correlation to real estate. However, it is an overall view of where our economy is in terms of stability, okay? Economic growth, that's another great key point of economics, microeconomics that you have to understand. The strong economic growth typically boosts job creation, wealth, demand for real estate and commercial property, okay? Most common that we all understand, employment and wages. Obviously, the more individual makes, obviously, the more they can borrow against, and then they can afford more, invest better, all that good stuff. Government policies and regulations. I think it's very key to understand policies, even if it's not in your direct market, but from a global scale, right? Tariff is probably a new point of topic. Another one is inflation, which we already talked about. So if you understand those key components, you have a broader understanding of where the economics are, trends, highs or lows, plus or minus, right? And then supply demand. We hear this all the time. The more supply you have, the less demand. The less supply you have, the more demand. So if you understand those 6, I believe there's 8. These are the 6 that I personally always consider when I look at a deal, when I help a client. So if you understand those key components, I think you'll be fine helping your clients to achieve their real estate goals, okay? This is my lady, Judge Judy. She's pretty cool. She's very smart. In her show, she always tells individuals how smart she is. So when you maximize your return overview, this is what this page is. We're going to talk about that a little bit. So let's go one by one. Marketing conditions, right? Supply and demand dynamics. which also falls on the umbrella of interest rates and financing costs, right? Also, economic trends and job growth is under market conditions. The population growth and migration patterns, location and property selection. So all those fit in the same umbrella as market conditions. So if you understand any of those components from migration, one of the key topics right now is deportation. So that's going to obviously change population growth, strength, and demand. Also interest rates and what the financial cost is to borrow money. I think it allows you to understand what market conditions are. From Instagram to HGTV, we all heard the three wonderful words: location, location, location. So if you understand location, it allows you to have a better property selection for your end client. The proxy to key amenities, right? So churches, malls, schools, hospitals, even Amazon warehouses now is a key component to realize what some of the market locations could be benefit your end client. So if you understand, for example, most cities also have a master plan and on their city doc that gives you an idea high or low, what's coming to the city, what's planned, what's already approved. So for example, the city of Miami Beach in 2040, they have their master plan already on their website. So you can go there, look at that, and then peel the onion back in terms of opportunities for your clients if they want to buy in that area. And it gives you a high level of how to speak, what to say to them. Also, neighborhoods appreciation potential. So if you know that there is a multifamily coming to the area, if you know that there is a school, a charter school, that's one of the top charter schools in the country coming to Tamarack, Liberty City, or something like that, that allows you to understand the location mindset. Okay. Another part, criminal crime rates. Crime rates is not something that you want to quote unquote say this is a good or bad area, but it gives you an idea to share with your clients what those rates are. And you allow them to have the subjective opinion of what that is, but you share that with them so they understand the location. And then zoning and regulations, future development plans, as we mentioned. But if you understand the zoning restrictions and or the potential, so if they bought a single family home and it's actually zoned in a multifamily, down the road, you can express to them that that particular deed would allow them to build a multifamily. So understand the location, I think, is very key. Another one, financing, leveraging. So when you have debt service, you're going to borrow money against a loan, understanding those dynamics. So the loan terms and interest rates is very important. The debt to equity ratio is very important. So in other words, if a property, you're borrowing money against it this way, and then your equity play is this way, meaning what the property is worth based on what the value is, it gives you that debt to equity ratio. And I think that's very important as well. So you understand how to give a spin on what they're actually reviewing. Cost of capital and cash flow impact also falls on the umbrella of financing and leverage. It allows you to understand how much that money is going to produce based on a cash flow basis. So whether it's a warehouse, whether it's a multifamily, how much money is it going to produce based on the cost of that capital to borrow and then the cash flow impact. I think this is one of the most basic terms that we all heard: loan to value ratio and the risk exposure. So a lender, when they borrow you money for a particular asset, they're going to have a loan to value. So if the property is worth 100,000 and they say we do a LTV of 75%, that means they're only going to borrow you up to 75,000 of that $100,000 value. So it's important to understand if you get a position play, which Lord is not a huge equity play environment right now. However, it still allows you to understand how to advise your client best, right? And then another one, rental income and cash flow. This is an interesting topic. So here in South Florida, because we are prime real estate, it's relatively difficult to have quote unquote cash flow. However, it's subjective to the investor. So an investor say they want to be X, Y, and Z cash flow. There's a way to reinvent that. However, if they borrow money, it's going to be relatively tough because their debt service is also going to hold against their expenses. So your typical expenses, your taxes, insurance, lawn care, PM, capital expenditures, these are all expenses. And then your debt service is another expense by itself. So with those two components, you're going to also have what's your cash flow. And if you don't have a cash flow, it's going to be difficult for them to see that, but you have to give them the overall view of appreciation, tax exemptions, all that wonderful stuff. Okay. Tax benefits was the next segue. Incentives, tax benefits. We have the affordable grant that's out there for developers and builders. So that's a huge play for developers that want to build. You have tax benefits. You can't necessarily give advice because we're not licensed as accountants, but you definitely want to give them the overview and let them assess it themselves. Risk management and diversification. I think when it comes to risk management, you lay it out to your clients. You know, you have the portfolio across asset types and locations. You have the insurance coverage and liability protection. You have economic turn down and preparation. You have the legal and regulation compliance. Fix and flip are one of those things to understand the risk management of everything. I think when it comes to risk management, you give the client exactly what they need, and then you give the spin based on what they say from there, if that makes sense. Okay. Property appreciation, add value. So added value is an interesting player here in South Florida because you are buying at a relatively higher mark than other markets. However, when you are able to cover your insurance, your liabilities, all your debt service, I think you're already adding value to that particular property, right? So if you understand how to assess, get your insurance quote, get your materials, depreciation, it allows you to have those conversations with your clients. Okay, multifamily, apartment complexes, duplexes, steady income is important when it comes to maximizing your return. The Burr method, some people call it Burr, some people call it fix and flip, some people call it HGTV, flip shows, whatever, but it's pretty much the same thing when it comes to buy, rehab, rent, refinance, and then repeat the asset. Okay, commercial is self-explanatory, right? So that's my overview of what maximizing returns. Understand those components, those 7 components, I think would definitely benefit you to add value to your clients as the licensed professional. Okay. Next slide here. And if at some point, everybody, if I pause and it's like I'm frozen, it's not I'm frozen. I have allergies right now and I need to sneeze. I'm fighting through for you wonderful folks, but the pollen today was pollinating. It was definitely pollinating. Let's see, move the screen down. Okay, so this is high and value growth areas, buy in high growth areas. So I did this little wheel. I think it gives a great explanation of what I mean by that. If I could just move that over, there we go. Okay. So the very first one is buy in high growth areas. So if you know there's a major school coming, if you know, for example, Wynwood to have the first Florida trading, stock exchange trading floor coming. Downtown Miami, they're getting some great projects, right? They got the the Bentley building, they got the Porsche building already, that's something else. But if you understand what's coming to the market, it allows you to buy in those high growth areas, okay? Optimizing cash flow, choosing a property with strong rental demand to ensure some consistent cash flow, reducing the operating costs through tax benefits, energy efficiency, upgrades, and strategic financing. So essentially, if you're able to scale backwards, it allows you to have a positive cash flow, right? So if you buy an asset with the unfavorable cap rate, you're able to add different strategies to either maximize or minimize that cap rate, right? So if you add wash and dryer, if you provide hurricane impact, if you provide solar options, those allow you to optimize the cash flow, okay? Investment scope, understanding your clients, and if you're an investor like myself, understanding your investment scope, and you shouldn't defer. It should be either what you are and or what your client is, right? So if they want cash flow, I have a client, all he does is buy short-term rentals. That's it. He'll buy cash, do some renovations, and then he'll put it right on the market a couple months thereafter for a short-term rental. So understanding that investment scope, whether it's long term, you have your mid tenants, you have your long term tenants, annual basis. Understanding that would do you a good service to maximize what you're looking to do. Obviously, the next point here is value add. So when you do value add, invest in these are equity plays, but not right in South Florida. But essentially, you want to invest in fixer uppers or outdated properties that can be renovated for appreciation. So if you have even a 4%, 5% on the floor appreciation from when you purchased it from, you can add on to that. So again, you add a new roof, you add a new bedroom if it's feasible, add a new bathroom. So these are some add value opportunities that on the surface would allow you to definitely add value to those properties. Another one, market cycles. Every market goes through all type of cycles. There's nothing different than what we're going through currently. It's nothing different than what we went through in 2008. Just a different understanding of the market cycle allows you to maximize that. Diversify, self-explanatory, right? So you always want to diversify. So if you do short-term rental, maybe you explore long-term rental. If you do fix and flip, maybe you also do some buy and hold, so some rental properties. If you buy just land, maybe you buy some existing dwellings, demolish or renovate that particular property. That way you can diversify on your property types. Consider maximizing consider mixing, excuse me, residential, commercial, and some multifamily. This allows you to spread your risk because if you have one unit that is renting very, very well, that's the only property you have. God forbid if that individual lose their job, get deported, for example, just stop paying, your income goes to zero. It wouldn't be it would be a vacancy rate, right? But it would be 100%. So if you can diversify and have multiple doors or multiple asset types, it allows you to play that risk. And just look at it from something common like McDonald's, right? McDonald's, they don't have one store, they have multiple stores. And some markets do as well, some markets don't do well. So diversifying, I think, is key. Financing, obviously, you're always going to leverage, you're going to try to leverage low interest rate loans or create a financing, seller finance. I haven't seen seller finance down here in South Florida. I know some markets say, oh, I want to do seller financing for it's so expensive, but I haven't seen a financing, seller financing that makes sense by the simple fact they're going to want a significant amount of money up front. I'll do that. They're going to want a significant amount of money up front. Secondarily, the terms would obviously be seller driven. It wouldn't be a buyer opportunity. But if you have a client that's in that space or you're in that space and you're able to get seller financing, then the numbers work. But I just personally haven't seen one in a long time here in South Florida that makes sense. Okay. Microeconomics, we went through that, but I'll just go a little bit further into that. So stay updated in inflation, right? Stay updated to the interest rates. Supply and demand is very key, especially here in South Florida. Adjust your investment strategy based on economic conditions. Simply put, if interest rates are one way and if expenses and inflations are one way, then you alter what you want to do, right? So in other words, if interest rates are relatively high, maybe you don't leverage a loan. Maybe you stay where you are and you reassess next year or quarterly when you understand the trends. You're able to either refi or then go back out there and acquire a new asset. Or sometimes it's better to just liquidate and hold your money and then pump it back into the market when you feel it's feasible. Okay. Next slide. What is this? So this is a real world example of a property that I underwrote for a client that was looking to purchase a Chick-fil-A. Okay. He wanted to purchase the asset as the franchisee and then down the road, maybe sell it or have a tenant to purchase from him while he's still collecting as a passive. So I'll give you some of the highlights of what I saw in this property and why it was of interest. And this is in Tampa. So to full transparency, this was in Tampa. Some of the highlights, it was backed by a strong corporate tenant, which everybody knows Chick-fil-A. I'll let Simo in. The NOI on this particular property was $390,000. It was a 20-year initial lease term. Okay. The asking price was a little under $2,000 a foot. Yeah. Yeah, that was one. That was one. The rent square foot was $8.70 a foot, and the cap rate was 3.71. All right, 3.71, yes. And the population in Tampa rose by 1.32 per year from 20 to 2025. And I'll give you a reason why that's important. Um, and then the pros that we liked were simply put on the surface, right? So great location. Tampa is a great area. The location was off the highway. It was 100,000 VPD, which is vehicles per day. Tampa, obviously, I think Tampa is one of those markets where it's the entry is still affordable. So the population is always going to have relatively high growth. The other component that was a pro was absolute triple net. The taxes and the maintenance were all included. The proxy to great location, traffic, drivers. It was also off a strip of a mall, so it was an out parcel. Chick-fil-A was the anchor, so it was the biggest corporation in that particular area. It was obviously brand new. It was a 2023 build, okay? And it was an 8% increase option for the landlord. So what that means is every year the landlord capped was at 8%. Okay. So on the surface, those were the good things that we liked, but my client liked, and I was able to highlight that for him. Some of the cons, some of the bad things, right, about Chick-fil-A, right? So Chick-fil-A is a great company. It's really attractive. However, their investment grade, what they say in the underwriting world, was relatively low. And what I mean by that, Chick-fil-A is closed on Sundays. So that's 52 days per year they'll be closed. Sprinkle in, again, we're in Florida, so hurricane season. So let's call it 80 days a year that they can potentially be closed. That's 80 days that that particular establishment won't have any income just based on those circumstances. So that was relatively low. The cap was too low for my client. He wanted to be plus or minus 5%. More is better, but on the surface, once we scaled the onion back, so to speak, we're at a 3.71. This one was at a 5. Okay. It was negative leverage for my client, and based on what he was borrowing at a 7.5. The cap rate here is 3.7. So it just didn't make sense from that standpoint if you want to leverage a loan against it, right? Configuration plan. So the other part was I think that was a line and put it in wrongly. The rental rate was over 20 years. So that meant if my client bought the property, he could not increase the rent for 20 years. It was locked in, which is bad because for him, he wanted to purchase and then potentially rent it to someone else if, circumstances change for him. But in the contract between the landlord and the location, 20 years, couldn't touch it, right? So that wasn't the best move for my client. And then the depreciation was more than the actual cash flow with all those circumstances. So in summary, this was a solid investment. It was a dependable tenant with long-term success potential. However, if investors are comfortable with low cash flow rate, it remains as an excellent option, investment option. My client decided to pass on his opportunity by those reasons that I've highlighted in cons. Another key point about this particular Chick-fil-A is privatized, which simply means their financials is not public record. So if you ask Chick-fil-A as a franchisee, they're not obligated to give you sensitive information about the corporation as a whole, and then also your location, but they do monitor your financials. So for that reason, and many other reasons why that I highlighted in cons, I'm out. Right, Shark Tank? I'm out. So the deal that makes sense on that. Okay, so that was a real life example, and this is a $10.5 million deal. So that's how more or less I look at deals. I guess I have to set it. Okay, so next slide. Okay, so by the numbers. I just get rid of this. Okay. As I mentioned, the population growth, if you're over 1% annually on population growth, that's big, right? So if a population, for example, with Tampa, they're at 1.3, right? So that's tremendous in a population growth standpoint. So from 2020 to 2025, Tampa increased population by 1.3, and that's great. Inflation, you want to be historically right now, I think we're at 4.43 inflation. You want to be 2 minus. That's a steady, sustainable inflation rate. So if you're around 2, you're doing great. Higher you get, obviously that means there's blood in the water, as they say. If we get to 5% on inflation, yeah, 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 it'd be fun. It'd be fun. 4% cap rate. Everybody always asks me, what's a good or bad cap rate? I think that's subjective. You have some investors that like a low cap rate. That means that appreciation or the asset is high. So if you buy a hotel in South Beach, for example, that cap rate will be lower. You're somewhere around 2, 4. I haven't seen 2.5 now. But if you're at a 4, I guess that's common for prime real estate in major cities, right? Low risk, stable returns. 8% GRM, that's gross rent multiples. 8% is pretty standard. 8% is a higher risk, but it's a higher return. Some markets, often found in secondary markets or distressed properties. But if you have an 8, that's pretty good. 12, 15 is great. 15 and 20 is amazing. Haven't seen those. But if you get below 8, you might have some cause for concern. And then your cash on cash return, 8% is pretty good on a cash on cash return. But again, it all depends on the investor. Investors have their investment strategies, their investment scope, and when they have that number, it's important that you're able to explain and also understand it, right? So when I get property, I always ask for a P&L statement, a T12. That allows me to underwrite the property effectively, and that allows me to also look at these components that I mentioned to you: cash on cash return, cap rate, and then I do my due diligence on the governmental side, the population growth, and then inflation. Okay. Great. Actionable items, next step for investors. So these are some of the 6 things that I assure my client, and at the end where you see keys and deeds, I have that mantra throughout the process for my client. Understand that let's not get excited until we get keys and deeds. But the most important part are these 7 steps for underwriting a property for your client. First, investment goals. What are their goals? What are their intentions? And how can we get there, right? Secondarily, market and economic analysis. Understand what they already told you, and then how do you minimize the risk based on the market. Financial and investment metrics. Understand the debt service for that particular asset. What is it going to take to achieve your client's goal with the financial investment? So if the client is saying, I want a 7% cap, I want a 12% cap, it's very important that you understand the financials to underwrite those such things. Okay. Financing asset selection and due diligence. So once you understand 1 through 3, for example, it's very important to now get the asset that fits those numbers. Oftentimes, you're not going to find a perfect deal as soon as you click on the property, but now you scale it back based on the information that I use. I now identify properties on the surface that may have plus or minus 7%, right? So if my client wants X, Y, and Z, plus or minus, I go above and beneath that number, 7%. And that gives me a little wiggle room to see if it may work. Then I'll share it with my client, then I'll provide it, and we go from there. Okay. Financing and capital structure. This goes under the umbrella of leverage. This goes under the umbrella of seller financing. So if a client wants to get debt service, meaning a loan, then I understand the financing structure for him, and then also what money is said client bringing to the table to make the deal work, right? And then obviously we all have done this hundreds of thousands of times, negotiating, closing, which is the fun part. Post-purchase strategy. This goes on the line of exit strategies, right? So if your client says, for example, my client with the Chick-fil-A, he said, Duriel, this is what I want to do 5, 6 years from now. I want to then sell this to another buyer and these are the structures that I want to do it. So I had to keep that in mind as the post-purchase strategy. How can we maximize your intentions 4, 5, 6, 7 years from now? But that particular deal didn't make sense because on the surface, we had all the beautiful things that comes with Chick-fil-A, but 52 days closed, another whatever 15 days with hurricanes throughout the year. So that gives it a little under 100 days that it's not going to be available and producing any money. So on the surface, it just didn't make any sense from a very high level standpoint. Okay. Next one. Uh, Warren Buffett. Warren Buffett is, I think, one of the greatest investors of all time. Um, I read a lot of his books, watch a lot of um, um, online information about Mr. Buffett. And one of the things he always says is the difference between successful people and really successful people is that successful people say no to almost everything. If you think about your most sophisticated investor, 9 out of 9.9% of the time, they're going to say no to a deal, right? And that's because they understand the deal that doesn't work for them. However, if you find them the right deal, they'll say yes. So you just need one, but most investor would definitely give you a negative response as long as you present it in such of a way that's completely clear and decisive. But if you find that one deal, it can change everybody. Okay. But along those lines, long-term wealth building, right? Market cycles, understanding those, compounding returns, leverage and financing, long-term wealth building, strategic improvements. If you understand those 6 components when it comes to investing and underwriting and maximize your clients' returns, you're going to do amazing. Clients, what I've learned, um, I love my brokerage, Canvas, love it. But I know other brokers that go to different brokerages and they always have their clients. And that's by the simple fact they've done a great job to add value to their clients. So if you're one of those types that goes to different brokerages or different, um, um, if you do, in-house sales or whatever, you go to different locations, it's very important to understand that you're creating value and that long-lasting business relationship between you and your client, not the brokerage, if that makes sense. Okay. This is the next slide is what I'm calling the bonus. Even though the numbers are very, very important, I think before you even look at numbers, it's important to understand these 2 components, competitive advantages and structural advantages. Okay. Very first, competitive advantages, amenities. What are you near, right? So once you identify the asset, now you identify the demographic to maximize your client's investment strategy. Okay. So for example, if they're in student housing, okay, being in close proximity to a Chick-fil-A is key, right? Being close to a Amazon warehouse. Amazon warehouses now are producing 15 to 20% more appreciation than properties that are relatively further than Amazon warehouse. By the simple fact, the notion you get that 2-day delivery time and then also return time, right? So if you're near one and you understand that, then that's a monetizing value. Okay. Also understanding the layout of that particular property that you're looking at. So if it's a 15 unit, 35,000 unit, what is the mixture of beds, right? Is it 42 units of 1 bed or 1 bath, all 1 unit studios? Those components also give you the understanding what is your competitive advantages in terms of investors want to invest in that property and individuals coming to the property to want to rent. Another one, if you understand your target demographic, then dog parks or animal parks. I'll just say pets park. But for the most part, if they have pets, having a park relatively on the grounds or relatively near the asset is a monetary gain for you as the licensed professional. Okay. Structural advantages. This relates to market conditions. And by analyzing the structural advantages, by in-person virtual, just go see the property. Physically go out and see the property that your client identifies as an area and an asset that they like, okay? Limited housing could drive significant year-over-year rent growth. For example, if a property is in a high demand area, typically speaking, there's not a lot of assets that will probably come to that market again because it's already probably at its peak, right? So you can find the outskirts of, for example, Wynwood. I think Wynwood is at its peak, right? I think Wynwood is utterly at its peak, but there are other subdivisions that are relatively close that are trying to achieve the same goals. For example, Little Haiti, right? Calle Ocho is starting to get those tentacles of Brickell, right? So if you look at Calle Ocho of recently, they have a lot of plans of some high rises. And when I was a kid, Calle Ocho was not high-end luxury, but now they're starting to trade at give or take $400 or $500 per door from a multifamily standpoint. So that's pretty much how I look at deals, how I help clients analyze deals. I would definitely love to open the floor for questions, comments, anything people have. I will go to the chat now. Give me a second. Here we go. So let's see how I do this. I don't know if you're still there, Kev, if there's any hands, feet, any Zelle payments, nothing there. Let's see, somebody got a chat here. How do you think? So great question, Mr. Allen. Shout out to you. I think opportunity zones are going to be the next wave. It's not approved yet, but that's going to be the next wave in investing. Essentially, it goes across all asset classes, not just real estate. But opportunity zones going to allow individuals to invest, maximize that return. I think if you understand your client's objectives, you can also add the sprinkle that this property is also in an opportunity zone. So great question. Information. Yeah, I appreciate it. I'm going to go take this Claritin D. Shout out to Catherine, our in-house ear, throat specialist. She told me go get some Claritin D yesterday, so I've been on that. But yeah, I appreciate it. Any other questions, any other comments, anything that I can help you wonderful folks, how I look at deals? Okay, perfect. Well, thank you guys so much for attending. Kevin, thank you so much for allowing me to do this. I hope there are more and more that I can offer. I don't know, Kevin, if we're going to record this and share it later, but I'm more than willing to, I don't agree with it.
So yeah, this is being recorded and we will get you a recording next week, along with the links to our next class, which is 6 AI tools to help you with your business now. That'll be part of our Tech Tuesday, and that will be April 1st. That's on a Tuesday at 11 a.m. So we hope to see you there, and we'll send you all the information for it. And Duriel, thank you so much for teaching this class, man. We greatly appreciate all your help.
My honor. Did you want to mention the events again that you mentioned at the beginning?
Oh, no, it's okay. I will send the links. I'll send the links for the We Wire Lady Leaders when this recording comes out. Don't you worry. Along with F1, YPN Pro Talks. We got a whole bunch of things coming up.
Yes, sir. Second quarter is going to be amazing. Thank you, wonderful folks. You wonderful professionals. Go crush it. Go kill it. I hope to meet some of you that I haven't met before. I hope to see some of you again. Thank you guys so much for your time. Take care, everybody.
I'm a YPN leader. Of course, I'm going to be on my laptop.
I'm a YPN leader. Of course, I have a full purse.
I'm a YPN leader. Of course, I'm eating before I leave.
I'm a YPN leader. Of course, I'm sneaking out for shopping.
We're YPN leaders.
Of course we're going to be creating content.
I'm a YPN leader. Of course I'm signing up for classes.
I'm a YPN leader. Of course I'm Cafecito obsessed.
I'm a YPN leader. Of course I'm going to crash the next happy hour.
Yeah, but on my way home, yeah. still amaze me? Wouldn't it be crazy? Would you still amaze me? Wouldn't it be crazy? Would you still amaze me? Wouldn't it be crazy? Would you still amaze me? If I find my way home, yeah. If I find my way home, yeah. Wouldn't it be crazy? Would you still amaze me? Wouldn't it be crazy? Would you still amaze me? Wouldn't it be crazy? Would you still amaze me? Wouldn't it be crazy? Would you still amaze me?